We haven't seen rates this high in over 20 years. In fact, the last time rates were this high, we were going through a major market crash in 2002 with the S&P losing over 50% of its value. When I swapped out of my super low rate 20-year mortgage for Paidoff in 2021, I did so with the adjustable rate option because at the time, rates were at all-time lows and hadn't moved in years. No one was expecting the fallout we're seeing now, and you're probably wondering how I'm dealing with that. Have my payments exploded? Has my loan balance increased? Am I financially underwater? We're going to dive into that, and I'm going to prove to you with my statements that higher rates have had very little impact on my ability to pay my mortgage down. Let's step back a bit. The first time I heard about Paidoff, it was really hard to wrap my head around. Statements like index rates, nightly sweeps, daily interest calculations, monthly interest payments, it was a lot of financial jargon all at once. In fact, I was a little bit skeptical because Randy kept telling me that I shouldn't even worry about the rate. Well, why shouldn't I be concerned? I mean, it's quite a bit higher than the rate on my traditional 20-year mortgage, and it can fluctuate every month. Well, now that I know how this all works, he's absolutely right. Of course, I would love to go back to the low rates of 2021, but at the end of the day, it's all about paying the principal first, which shortens the time period of your loan and significantly reduces the amount of interest you pay. You know, it really wasn't until the first few months of this loan that it all started to click. So let me explain to you how this product works in the easiest way that I know how. Okay, so outside of the rate, which again isn't all that important, the product crushes the standard mortgage for several reasons. First, your checking account is tied directly to your loan. So as soon as your income hits your checking account, it gets swept into the loan overnight. What this means is that every single available dollar goes towards reducing your loan balance with the largest possible payment. This means that your money is no longer sitting in a checking account doing nothing. It's reducing your loan in one large payment. With a traditional mortgage, you're making a small payment, hardly any of it goes to principal, and interest is stacking up against you constantly. Some of you may be wondering how you can pay your bills or use the ATM if your checking account is being emptied every night. Well, you do so in the same way that you do now, but behind the scenes, all that is happening is you're shifting money from your loan over to your wallet or over to your bill collector or the grocery store, whatever it may be. In return, your loan balance is increasing slightly to account for those expenses. So for example, if you owe $100,000 on your loan and you need to spend $2,000 on bills, well, you now owe $102,000 on your loan. It's really that simple, and it's really that effective. When you're not spending money, your loan balance remains low and you're saving interest. When I saw my first couple of statements, I had to take a double take because we had paid down so much principal in a very short amount of time. It was almost too good to be true. Now, also think about this. Do you pay all of your major expenses on the same day of the month? More than likely you don't. And the reason I bring this up is because with this product, it means the bulk of your cash is saving you interest for a very long period of time. Meaning as long as you're not spending money or paying bills, you're keeping your interest fees as low as possible because your loan balance is as low as possible. Remember, with Paidoff, the interest you owe is calculated daily, so it benefits you to have your money swept into the account immediately and have it sit as long as possible. The last point, which is equally as important, is that while you are paying down your loan, you're also increasing your line of credit at the same rate. Remember, you're replacing your loan with a HELOC. So as your $5,000 paycheck hits the checking account, you're not only reducing your loan by $5,000, but you're also increasing your line of credit by $5,000. It's truly a win-win with Paidoff. Well, you're probably chomping at the bit to see how I paid down $100,000 in 18 months, even with this crazy market environment. We were able to do this in a couple different ways. First and foremost, we moved all of our rainy day funds out of savings and immediately into the synced checking account. See, when you have access to a credit line, there's really no need to keep a rainy day fund because you now have this credit line and it's far larger than what we had before. Leaving that money in savings would do nothing, and it was just ridiculous. In fact, I often shudder just thinking about how long it sat there. We also had a considerably large checking account because over time, it too would grow when our monthly income was greater than our monthly expenses. Again, no advantage whatsoever to maintaining a large checking account balance. For years, I'd wanted to do something with both our checking and savings accounts, but I couldn't find any investments that would allow me easy access to the money if I needed it. With Paidoff, you can literally access your money 24/7 because your checking account is linked to your line of credit. Beyond that, we really didn't change anything else about our spending habits. That might be hard to believe, but it's the honest truth. Initially, we did get a Mint budgeting app to track our spending, since you can no longer track your expenses through your checking account. Remember, it gets swept every night, so 95% of the time, it'll show $0 when you log in. Once you get over that, it's really no different than what you've been doing all along. There are some tricks to maximize Paidoff by making a couple of very simple changes to your spending habits, as well as taking advantage of credit. I've linked that video in the description below, and trust me, you want to implement these easy strategies that I lay out. It will really speed up the paydown process. One last thing before I jump into these statements and show you the proof. I've always been an investor, so we have been taking advantage of the credit line to invest in real estate deals and other opportunities. You'll want to judge for yourself whether that makes sense for you, but I want to mention it now because you'll see that our balance fluctuates quite a bit due to these investments. What's really interesting, however, is that even when we had a very large balance, larger than any mortgage balance that we've ever had, our monthly interest payment was still lower than our previous mortgage payment. So let's jump into those statements and you can see for yourself. All right, the moment of truth. I have all my statements in this quick presentation, and I'm going to say up front, I wasn't able to go all the way back to 2021 because my account only allows me to get the last 12 months, but I have enough data where I think it really won't matter, and you will understand exactly why you need to be doing this. Okay, so to start off, I did take a screenshot of our loan balance when we started, so it was 196, and then this is what your statements look like every month. You're going to see the current rate that you paid during that month. You're going to see your principal balance. That's what you have, left to pay on your loan down here in the lower right corner. You're going to see your interest payment. So think of that as almost like, the payment you had to pay for having this $251,000 outstanding balance, and then your available credit line. So my total credit line was 533, and I have if you subtract 251, you get this 280 number. Pretty simple, right? All right, so zooming through, the next month, the rates went up. My balance is basically the same, and my interest went up slightly because the rate went up slightly, but really not a big deal. Moving into April, the rates continue to go up. My principal balance went up because I invested in some real estate deals during that time. But I'm still paying, $1,000, not really a huge deal considering my old mortgage payment was about $1,800 a month. All right, May, we're really bumping up again. Principal balance is up to $400,000. Interest is still very manageable. Moving into June, very similar. The rate went up. The interest payment is going up, but again, not really a big deal. All right, so into July, my principal balance came down quite a bit because we closed out several of those real estate deals. You can see the interest payment went down, and my available credit line has increased because I paid down the loan balance. August, rate goes up again. Interest payments going up. This is about the time I'm freaking out a little bit, but at the end of the day, I'll show you at the end, it doesn't really matter. Moving into September, the rates are continuing to go up. My balance is dropping because we're closing out some more of these real estate deals, and the interest payment has dropped a little bit. October, the rates are going up again. The balance is about the same, so my interest payment is slightly higher, still under that $1,800 that I'm used to. Then we move into a much bigger rate, 7.5%. I've dropped my balance down because we've closed out some more of these real estate deals, and the interest payment is still manageable. December, high rate, balance dropped some more. Interest rate is still about $1,500 a month. January, big rate, 8%. But again, if you look at standard rates right now on mortgages, they're near 7%. So this isn't a huge deal. My balance has dropped, but I am paying more interest. And then at the point of making this video, the February statement hadn't come out, but this is a screenshot of my account balance right now. So I'm at 193. And if you remember, that original balance when we started was 196. So you're probably thinking, well, that's not, you didn't pay your house down 100,000, but there's a couple things here, guys. So 96 was the original loan. Right now, I have $20,000 out in a real estate deal that's going to be closing here soon. And then I have another $100,000 out. in another deal. So my balance should technically be 76,000. So that's pretty amazing, right? So if I do 196 minus 76, that's like $120,000 that I've paid off. In fact, that's even shocking. I didn't even realize it was that high. So the point is here, guys, the interest rate doesn't matter. It's the way you're paying down your mortgage on your loan balance, I should say, on a monthly basis. You're putting all your principal towards it. And so it's just annihilating the balance, saving you tons and tons of interest. So if you're watching this and it's something you want to talk more about, please reach out to the Paidoff folks. They completely changed my life, and I know they can change your life too. If this video has been helpful in any way, please let me know. I would love to hear from you. Also, please make sure you subscribe because I'm going to continue to document this journey, share my insight, and show you how this product can change your life.